All right, we are live. Guys, it was a really good week for dividend growth stocks as there were quite a few companies that announced some pretty substantial dividend increases, 5 of which we are going to be talking about in tonight's live stream. And interestingly enough, a portfolio of these 5 companies would have actually outperformed the market by quite a bit over the last 10 years, and that's something we're also going to take a look at in tonight's video. But guys, before we get into all of that, welcome to another Dividend Happy Hour. Why don't we kick it off with a quick cheers here. I'm just sipping some water tonight, but guys, here's to you. Thank you so much for joining me for another Dividend Happy Hour. Hope you guys had a great week, and we are in for a fun stream tonight. So I'm happy to have you all joining me. So cheers. All right. Also, guys, let me know a couple things in the live chat or the comments below if you're watching the replay. Number 1, what did you buy this week? Which stocks did you pick up? And also number 2, what are you sipping on tonight for the Dividend Happy Hour? Let me know that in the live chat, and also let me know in the comments below. I'm going to go through some of the comments here so far and just say what's up to you guys. Looks like we have the usual suspects in the building. Kevin's here. We've got Jay here. Harris, my man Harris. Po' Boy Jelly, good to see you in here. Adon, Rye, Luis, Ben, Mr. Burgess, Ron, Chris, Coyote, Paolo. Man, the whole gang's here tonight. Good to see you guys. Lucas is not miring my water again tonight. Yeah. Or maybe he's drinking water again tonight. I don't know. Dan's in the building. We've got, who else? Big Kahuna. That's a cool name. Chris here, who is drinking a champagne-flavored Bang energy drink, which he says is tasting better than he thought, which is good. Good to hear that, man. Glad to hear that. And also, Chris, man, you got to let us know. Apparently, Chris added a new stock to his portfolio, so you got to let us know which one that is in the live chat. You've been holding out on me, man. I'm excited to hear which one it is. I see Journeyman in here. We got Todd, Victor, Retired FM29, TCAF, Angel, Norman, Asaf, Judy, Ultra Runner, good to see you, Phil, Ethan. Whoa, Ryan. We got Big Bad Jack Murphy in the building. We've got Robert. Did I already say what's up to Norman? I think I did say Norman. Norman says, please only drink water, sir. Nothing else. No milk, no juice, certainly no margaritas. Norman wants me to keep it clean. Okay, well, for tonight, I will do that for you, my friend. But in the future, I cannot make any promises. Who else we got? Leroy's in the building. Xenon, Julian, Ron. I already said what's up to Ron, I think. Man, so let's see. Let's go back through these, see what you guys picked up this week. So I see some SCHDs. Always a good buy. I see Po' Boy Jelly picked up some Intel. Good move, man. Actually, a bold move, I should say. Kevin here picked up some Stanley Black & Decker and Whirlpool. Good choices, my friend. Good choices. Let's see here. Who else we got? What else we got going on here? Ethan held both Palantir and I don't know what DKNG is. I'm not familiar with that company. Let's see here. Robert, good pickup. Some Medtronic and Procter & Gamble. I bought some Procter & Gamble this week as well. Procter & Gamble and Johnson & Johnson. So love it, man. Love it. Let's see here. See some more SCHD, some Altria Group. Okay, so here's that new position for Chris. He bought one SCHD, half a share of Walmart, which you guys, his Walmart position is off the chain. And his new position is Johnson & Johnson, which is a great time to buy J&J. At this point, I don't know exactly how much it's down year to date, but I believe it's somewhere between 7 and 8% last time I checked. And if you guys saw my recent video from Wednesday, I've been swooping up some more shares of Johnson & Johnson myself. Last couple weeks, bought some. Bought 2 different tranches this week, so definitely trying to add to that position while I can, while it's below my average cost per share. But Chris, man, good for you. Good entry into Johnson & Johnson. Nice, man. Let's see here. What else we got? We got Russ in the building. Russ, good to see you, man. Picked up some ASTL. Is that okay? So Russ, I haven't listened to your newest podcast, but is that the new stock that you added to your portfolio? I'm curious. Also, Russ, man, what are you doing? You have any interest in hopping on the stream here in a few minutes and hanging out for a bit? Once I get through these 5 stocks with huge dividend raises, I'd love to have you if you're hanging out. Oh, Ethan says DKNG is DraftKings. So, fun fact about... Oh, he's driving. Okay, no worries, man. So DraftKings is actually right around the corner from where I live here in Vegas. It looks like they're building, I don't know if it's a headquarters or what, but it's like it's a huge brand new building, huge 3-story office building just for DraftKings. And like I said, I don't know if it's their new headquarters or where exactly their headquarters is, but it looks like it's going to be a really nice building. Cool, man. Let's see. Well, guys, I think we're all caught up here in the comments. How about we just get into the main event, right? So for those of you who are just kind of now joining the stream, there's 121 of us in here right now. Tonight we are talking about 5 different companies who announced some pretty substantial dividend raises in this last week. Like I said in the intro, it was a very good week for dividend growth stocks. And we had some pretty crazy dividend increase announcements or dividend raise announcements. I don't know how you word that right. You guys know me, I'm always tripping over my words. But anyway, guys, this first one, okay, so actually before I get to this first one, all of the stocks we're going through announced double-digit dividend raises except for this first one, which was just less than 0.5% below a 10% raise, if that makes sense. But anyway, guys, this first company here is Brunswick Corporation, BC, who announced a raise of their dividend by 9.6%. So like I said, less than 0.5% away from a double-digit raise. And a 9.6% increase is nothing to turn your nose up at. This is looking pretty nice. And this is actually a pretty nice high-growth dividend stock. I don't know if you guys are familiar with this company at all, but basically what they do is they make all sorts of things that you might find in or near the water. They make boats, boat engines, and a wide range of other boating accessories like life jackets, sound systems for boats. If you've seen I think their biggest thing from what I've read is boat engines. So the Mercury line of boat engines, they make those. But anyway, real quick, just looking at their dividend stats, BC has a kind of lowish starting yield, 1.8%. It's whatever. Very low payout ratio, though. Less than 15%. That's extremely low. So this dividend is not stressing the company out whatsoever. They've got plenty of room to continue growing this bad boy, which they have, guys. Look at this 5-year growth rate, 16.34%. So their most recent dividend increase is below this average, but across the last 5 years, they've increased this by quite a fair amount, or at a pretty aggressive rate, I should say. And they've been growing this dividend for the last 10 years. But if we go over to the dividend history page real quick, I think they've been paying it for longer than those 10 years if Seeking Alpha will load. Yeah. Okay, so you guys can see right here, they have 19 years of straight payments. So 10 years of growth, but they've been paying that dividend for twice the amount of time, basically. And look at this, guys. Looks like they started paying this dividend, really back at the end of 2013. Before that, it looks like they were just making some small annual payments. Before that, it was really spotty. But since they, brought the dividend back for real back in 2013, it's grown pretty nice. That's a nice slope upward. So anyway, Brunswick Corporation looking good with that raise there. And guys, going over to the next stock number 2 out of 5 that announced a pretty big dividend increase. This one is CX Corporation, which is a railroad company that has a network of rails all across the country. And as you can see right here, they raised their dividend by 10%, which is nice. Love to see that, guys. And I'm going to switch over to Seeking Alpha real quick. We're going to take a look at their dividend stats as well. So CSX, excuse me, guys. Let's go over to the dividend page real quick. You'll see that this is another decently high growth dividend stock, definitely not as high as Brunswick, and actually a lower starting yield. So only 1.4% for the yield compared to 1.8% with the last company. But the payout ratio is also nice and low, about 21%, with a 9% 5-year dividend growth CAGR. I need to slow down a little bit, Ryan. Take it easy. Whoa, Nelly. And they've been growing this dividend for the last 18 straight years, which is nice. And I also think they've been paying this dividend for longer. So yeah, they have 33 years of dividend payments. So that's quite the record of consistency, if I do say so myself. So they've been paying this dividend longer than I've been alive since, looks like the late 80s. So that's pretty nice. And the dividend's been all over the place, guys. It's been up, it's been down, it's been up again, it's been down again. And it looks like they've really been doing well with it since about 2006, 2007. Right? It's been grown pretty consistently since then, it looks like. I mean, there were some periods here where they didn't grow it, but for the most part across these last, I'd guess 15 years or so, 16 years, they've done a good job of growing this dividend for the most part. So that's looking pretty good. And then moving on to the next stock that announced a pretty hefty dividend increase. And guys, these are going in ascending order. So with each new stock, we are seeing bigger raises. And this next one, guys, is Humana. I think that's how you pronounce it, but this is a health insurance company, and they announced a raise of 12.4%, so that's a very nice increase for this company. And we'll pull up their dividend stats here. Let me switch back over to Seeking Alpha, guys. Going over here and look at that share price, $510 per share. Wowee. Thank goodness for fractional shares, right? So going over to the dividend scorecard, guys, scrolling down, this is the lowest yield of the day. Not even like 0.75%. So 0.7%, extremely low. This is what we'd find on like an Apple or a Microsoft or even an Intuit, you know. But look at that payout ratio, guys. It's this is the lowest one. Like the dividend yield, this is the lowest payout ratio we've seen all day. Exactly 12.5%. So, you know, they got plenty of room to continue growing this bad boy, which they certainly have. They have a 14.5% 5-year growth rate, and they've been growing the dividend for the last 6 straight years. But let's see, have they been paying it for longer? So, okay, they've been paying the dividend for a little bit longer than they've been growing it. 10 years of straight dividend payments. And look at that. Oh my goodness, guys. That's a really aggressive slope upward in the growth department. Really nice, okay? So anyway, that's stock number 3. Let's go over to stock number 4. And I know we're moving through these relatively quickly, guys. But anyway, I'm excited to get to the Q&A, the hangout session like we usually do. So going over to stock number 4, this one is Analog Devices, which is a semiconductor company. And this is a pretty nice dividend raise from these guys. While many of the companies in the semiconductor industry, you know, are kind of hurting. Well, I guess I shouldn't speak for all of them, but Intel certainly is. This one is zigging while the others are zagging, okay? A 13% dividend increase is looking very nice. And let's go over to, let me pull it up on Seeking Alpha here real quick so we can look at their dividend stats. Going back over here, okay, scrolling down. Once again, a very low yield. And this is a pretty common trend we're seeing with all these companies. I don't think we've seen, and correct me if I'm wrong, guys, but I don't think we've seen a dividend yield above 1% so far. So that's not the most ideal, but anyway, 1.77% forward dividend yield. No payout ratio listed. I haven't looked into exactly why that is. But anyway, their 5-year growth rate's looking good, 11% on average. So this most recent increase was above that average, which is fantastic. And they have 19 years of straight dividend growth and the same amount of payment. So every single year that they've been paying this dividend, they've been growing it as well, all the way back to 2000, well, almost 20 years, 2003. Man, love to see that. So let's look at this actually. So because that looks like quite a bit of growth. So back in 2003, you were getting 4 cents per share per quarter. And if you would have bought in 2003, so 4 cents per share, all the way up to 86 cents per share. So that's basically 21x on the dividend, 21.5x on the dividend. That's crazy. That's crazy. That's awesome. And that's just, that just speaks to the power of like dividend growth stocks, guys, and why it's good. Like if you're someone who's younger and you've got the time to let those stocks do their thing, I should say, yeah, oh man, across a number of 20 years, 21xing your dividend income without having to lift a finger, you're just getting those increases. That's really substantial, and that's really cool to see. But anyway, guys, going back to the biggest raise. That I wanted to talk to you guys about. And you guys already are going to know what this one is. Actually, before I announce it, do you have any guesses as to what this 5th one is? I mean, if you saw the thumbnail, the raise was 19.6%. Do you guys have any guesses as to which company this is? Let me know in the live chat. Also, let me know in the comments below if you're watching the replay. But let me know if you guys have any guesses. I'm curious to see if you can get this right. In the meantime, I'm going to pull it up here on Seeking Alpha so we're ready there. Let's see. I don't see anything in the live chat yet. You guys are quiet. Come on, I know at least one of you guys are going to get it. Okay, I see Clorox, I see Texas Roadhouse. I see Dan wants me to give you a hint. The hint is in the thumbnail, okay? This company increased their dividend by 19.6% this week. It was pretty big news in the dividend investing community. I know you guys can get it. Okay, Rye says FTX. Yeah, certainly not. Po Boy Jelly says Starbucks. I wish it was Starbucks, but no, unfortunately it was not Starbucks. Jay thinks it was Realty Income. Victor says Waste Management. Come on, guys. You guys got this. I mean, really. Okay, I'm gonna wait for maybe 1 or 2 more guesses to come in, and then I'll announce it. I know one of you guys is going to get it. One of you guys already did. I'm not going to say who yet, but the answer has been said. Alfredo says 3M. Yeah, I wish that was the case for sure. but no, unfortunately not. Tara says probably medical properties trust. Brad thinks NLY. Unfortunately not, guys. So Harris, my man, you got it right. This last company is Texas Roadhouse. Okay, guys, they announced a recent dividend increase. They raised it by 9 cents to 55 cents, which represents a 19.6% increase from their prior dividend. So, whoo-wee, guys. Whoo-wee. I don't even know any other word to describe it, but that's pretty nice. And once again, just like all the other companies we've seen so far, dividend yield is pretty low, 1.75%. And this is the highest payout ratio we've seen all day, 46.3%, which still, in its own right, is really not too bad, guys. There's plenty of room to continue growing this dividend with a 46% payout ratio. I still feel very comfortable with that. Seeing like the 15s and the 12s and the sub 20 payout ratios that we saw with some of these other companies is sweet, but 46% is not bad, guys, especially when it comes to the 5-year growth rate of near 7% or 17%, excuse me. So their most recent dividend increase, 19.6%, is just a few shekels above, or I guess I should, not shekels really, because that's more like money, but a few percentage points above their 5-year average. So that's really great to see. But out of the 5 companies we've seen so far, they have 0 years of dividend growth, basically no growth history. So let's see what's going on here, guys. And also 0 years of payments. And if we zoom out on this max chart, okay, no surprise. I mean, it looks like they cut the dividend here in 2020 just for a few quarters and then brought it back sometime mid-2021. So maybe there was about a year or so there where they were not paying the dividend, which is understandable. I think, considering everything that happened in 2020, I think we can give them a pass for that. I don't know. What do you guys think? But I think they get a pass. They now, Seeking Alpha hasn't updated it, but they now should have 1 year of dividend growth because they had, once they brought it back, they had, what was it? If we go back over here, 3 payments, okay, in 2021. Excuse me. Then they increased it for all of 2022. And now they just increased it again here in 2023. So they should have 1 year of dividend growth. So they're getting somewhere. But anyway, guys, those were the 5 stocks that announced some pretty substantial dividend increases. And like I said earlier, if you would have had a portfolio of just these 5 companies, if you would have owned only these 5 companies across the last 10 years, like a portfolio, just these 5 bad boys, 20% in each one, you would have outperformed the S&P 500 or the entire market as a whole. Let's go see real quick, actually, what that looks like. So we're going to go over here. We're going to go over here to the portfoliovisualizer.com backtest portfolio asset allocation, which essentially allows us to do exactly what we're doing right now, building out a sample portfolio of these 5 stocks and seeing how it would have performed historically across, whatever period of time we determine. And in this example, we're going to go back the last 10 years. So 2013 to this year, including year to date. So, the first, 48 days of 2023. And in this example, guys, we're going to start back in 2013 with an initial $10,000 investment. And from there, every single week we'll be investing $100, which amounts to a $5,200 contribution or investment per year. We're not going to adjust for inflation. We are not going to rebalance. We're going to leave that off. Reinvest dividends, absolutely. Display income, yes, because we want to see what the cash flow looks like. And here, guys, we're going to compare. So these 5 stocks in portfolio number 1 compared to SPY, the S&P 500 ETF trust in portfolio number 2. So guys, scrolling down, this is going to blow your mind. Get ready. Scrolling down. So portfolio number 1, which is these 5 stocks, over the last 10 years with an initial $10,000 investment, investing $100 a week, you'd end up with $175,602 compared to if you did the same thing with SPY or the S&P 500, you'd have less than $130,000. So there's like what is that? A $46,000 spread right here. And just taking a look at how each portfolio would have performed in your best year with these 5 stocks, you would have been up 50.77%. In your worst year, you would have only seen a less than 5% drawdown, which is really not too bad compared to the S&P, where you would have seen your worst drawdown would have been about 18%, and your best year would have been 32%. So the performance is definitely the portfolio number 1 definitely has the advantage in terms of performance, right? And if we look at this chart here across pretty much the entire time, like there wasn't any single time where the S&P 500 would have beat this portfolio, which is crazy. And if we go over here I want to scroll up and look at the annual returns real quick here. And just looking at how some of these years performed, like portfolio number 1, 2013, that would have been your best year, 50.77%. But then the rest of the years, guys, it's not uncommon to see like a 20 to 25% return, okay? All these other years, there's only 1, 2, 3, 4 years, 4 out of 10 years. So 60% of the time, you would have seen a return over 20% with these 5 stocks. That's pretty unbelievable. That's crazy. And if we scroll down, guys, actually I have to scroll up, go back to summary. And if we scroll down and look at the annualized returns right here, can you guys see this right here? Yeah. Annualized returns. So every single year on average, this portfolio would have grown by just under 20%. That's a great return compared to the S&P 500, which also isn't too bad, 13%, but still near 20% return with these 5 stocks. That's not too shabby, guys. And looking at how that dividend income would have grown, in the first year, you would have been generating about $220. And then in this year, or actually in the last full year, 2022, you would have 10x that, okay? And you would have brought in almost $2,300 of dividend income. That's pretty nice. Yeah, that's really nice. And this might even be off a little bit, just considering how much growth the dividend has seen from all of these stocks. This might be off a little bit, but still, like 10xing your dividend income in 10 years is really not too bad at all. So, what do you guys think? How's that look? Pretty good stuff, huh? And actually, on that note, I have a question for you guys before we move on to the Q&A. Which are the highest dividend growth stocks in your portfolio? These ones are all pretty good. I mean, with the exception of, which one was it? There was one of those that did not have a double-digit 5-year CAGR, but all of them double digits, looking really great. But I want to know from you, which are the highest dividend growth stocks in your portfolio? For me, I think for me it's Lowe's. Let's actually go back to Seeking Alpha. And I'll put some of your responses up here on the screen here momentarily. I think for me, Lowe's is definitely one of them, which has a over 20% 5-year CAGR, which is very nice. I wonder if it'll tell me, Seeking Alpha should tell me the 10-year growth CAGR too. Yeah, so 10-year growth CAGR is even higher for Lowe's, 20.3%. And then I think another one is Snap-on for me, which has a 15.5% 10-year dividend growth CAGR, so that's not bad. And then I know Starbucks is another one as well. Starbucks and AbbVie are also up there for me. Yeah, Starbucks has a 10-year growth CAGR of 18%, so that's fantastic. So yeah, guys, those are my highest growth dividend stocks. Let me know what yours are in the live chat and also in the comments below. I want to put them on the screen, see what you guys are rocking with here. Let's see. Got to catch up in the comments real quick. Let's see here. Highest growth dividend stocks. Okay. Rice says Broadcom is one of his for sure. Broadcom's is near 30% for the 5-year CAGR, which is outstanding. Broadcom's looking really good. Eli says we've got a few in common actually. Snap-on, Lowe's, SCHD. Yeah, theirs is 13.5 or something like that, I believe. That's great. And then Kroger also has a double-digit 5-year CAGR. That's one that I'm still kind of chewing on for my portfolio. I'm really liking that company. Really liking it. Craig also has Broadcom. Ex-Dividend Dad, Cigna is one of his. What is Cigna's 5-year CAGR? I'm actually not familiar with that. Let's go check it out real quick. Cigna is, I don't know what their ticker is. CI. Okay. So Cigna's, oh geez, crazy. Okay. Cigna's 5-year CAGR is 156%, 157%. Their 10-year CAGR is 60%. What is going on here? Let's look at these. Okay. Okay, so they have 33 years of payments, 2 years of growth. So probably in these 2 years, they've really aggressively grown that dividend. But let's zoom out on this chart, yeah. Okay, so that makes sense. So back in 2020, they were just paying 4 cents. What was it, quarterly? Annual. So an annual 4-cent dividend. And then in 2021, they bumped it up to $1 every single quarter. So they really boosted that bad boy. Nice. Very nice. Okay, who else we got? Okay, Dan says Tractor Supply, Lowe's, and Cigna. Okay, nice. Tractor Supply is another great one. You know, that's I don't want to spoil the fun for Sunday or spoil the surprise, but on Sunday's video or in Sunday's video, I will be talking about Tractor Supply. So definitely check that out. Chantel also says Tractor Supply, Snap-on, and Hershey's company, or hers, or the Hirschi company. Rob, ARR. Alex says AbbVie, yep. Mike, ABR. Okay, wow, that's a really high 5-year growth rate, 18.6%. Charles says, hey, Ryan, happy birthday to your little brother. Today's my son's birthday, too. Oh, thanks, Charles. I'll have to let him know you said that. So I FaceTimed my little brother earlier this morning, and we always joke around with each other. Like, we're just constantly like poking fun at each other, just razzing each other. And so I called him to wish him a happy birthday, and I wrote this like poem. This sounds weird. I know it sounds weird, but I wrote this poem. And, I'll say things to him like how I'm the favorite, he's the least favorite. We used to put him on a leash as a kid when we took him on walks. We just razz him. And so basically this entire poem was just razzing my brother. Just wished, at the end, wished him happy birthday. But we had fun with it, and he was cracking up. Kevin, moving on, sorry. EOG is his highest growth dividend stock, a 24% CAGR. Oh, my goodness. That's crazy. Once you get into the 20%, like, I don't know how sustainable like a 20% dividend growth CAGR is, but my goodness, when you find those are lovely. Those are lovely. Journeyman, Lowe's, and Morgan Stanley. Let's see, passive dividends and options. AMT is a big dividend grower. What's their dividend growth rate? I remember theirs being somewhat high, but let's check it out real quick. I don't quite remember. It escapes me. I don't quite remember. Okay, yeah, 17.47%. That's wild. And you guys, I don't know if you guys remember this, 747, that's my number. I see it literally everywhere. Every time I look at the clock in the morning and the evening, I always see 747. Let's see. Okay, Mike says Key, 15.95%. That's really high. Po' Boy, Broadcom, BHP, BBY. Which one's BBY? Is that Bed Bath & Beyond? No, Best Buy. I don't know why. I don't know why I didn't know that, because you guys, there's something in the water. That's all there is to it. Okay, Ricardo, his top growth stocks, Lowe's. Lowe's is a very popular one. I'm glad to see that because it's a great company. Lowe's, MasterCard, UNH, United Health Group, United Healthcare, one of those, and F&F. I know Kevin's a big fan of F&F as well. Good choices. Eric says, ironically, SHW, despite the terrible dividend increase. Which one is SHW? Is that Sherwin-Williams? Yeah. Yeah, that actually, I looked at that company a while back. It actually surprised me. Just looking at the financials, they looked, from what I remember, they looked pretty dang good. Like really solid growth. That's a good, yeah. Let's see. TCAF, top five in his, Amazon. No, TCAF. We're talking about, we're not talking about share price returns. We're talking about dividend increases. But I'm glad to see that you made some solid returns on all those. That's good, man. Let's see. Adon, Texas Instruments, Russ, NXST. Dang. Ultra Runner. Congratulations. I just crossed 470 miles of ran this year during your live stream. Let's go. Dude, good job, my friend. That's crazy. So 470 miles. Let's do some quick math real quick, guys. So we are 47 days. He's running 10 miles a day on average. I don't even know why I reached for my calculator. We are 48 days actually into 2023. So Ultra Runner, you're running about 10 miles a day on average. That's crazy, man. Oh my God, that's crazy. Okay. Oh, Willie. Hey, big buddy. Discovered your channel today and subscribed. Great content. Thanks, man. Thank you, man. I'm glad to have you aboard. Happy to see you in the live stream tonight. Welcome aboard. Let's see. Julian, Target and Visa are his highest. Chris, Johnson & Johnson, Apple, and is Walmart one? Oh, Mike says his were the 10-year growth rates. Okay. So Adon says, how can ASML have a 5-year growth rate of 44% if their dividend growth has only been for 2 years? It's actually a really good question. So let's go take a look at this real quick. There's a simple explanation for this. So what was the company again? It was ASML, which is actually a pretty solid company, I think. Is ASML the one that makes the lithography equipment for the semiconductors? I think it is. Yeah. Okay. Yeah, great company. So we can see, like he said, they have a 44% 5-year CAGR, but they've only been growing their dividend for 2 years. Now, really simple explanation, Adon. So they've been paying their dividend for 9 straight years. So how do I best explain this? So they've at least been paying their dividend for 5 years. For 5 years. They've been paying their dividend for the last 5 years. Out of those 5 years, they've only grown it for 2. But still, across those last 5 years, because they've been paying the dividend, the growth that they've experienced in the last 2 years, you can take the CAGR across the last 5 years, even though they've been growing it for 2 years, because they've been paying it for 5 years. Hopefully that makes sense. I probably didn't do the best explanation there, but hopefully that makes sense. I mean, we can see if we look at the max chart, they've been paying the dividend all this time, but they just started growing it like here it looks like. And this dividend's all over the place, really. But because they've been paying it for so long, they can include that in their... Oh, I didn't switch over to the screen. Because they've been paying it so long, they can include that in their dividend growth history or when doing the calculation. Ethan wants to know, what's it like living in Vegas? Man, I love living in Vegas. I've been living here... October, November, December, January, February, almost 5 months now, which is crazy. And I love it. I really can't say one bad thing about it. It's exceeded expectations in every single way. I love where I live. And I'm so glad to have moved here. Yeah. Ryan says, hey, Ryan, so glad I was able to make a live stream while it's live for once. I love your videos. Keep it up. Ryan, man, thank you so much. I really appreciate the kind words, and I really appreciate all of the support on this channel. And that obviously goes for all of you guys watching, all of you guys out there. I really appreciate all of your support, and I'm so fortunate to have you guys continuing to tune in with me every single week. It's awesome. I love doing this. I love making these videos. Dividend Growth Income says A&T gives quarterly raises. I actually didn't know that, but that's pretty dang cool. Let's see here. G-Man, don't know. Fair enough, my friend. Fair enough. Okay, Asaf. VU, VTI, VYM, SCHD, Apple, Microsoft, AbbVie, T. Rowe, Procter & Gamble, Altry Group, Realty Income. That's my list, and I'm contributing every week. What do you think? I mean, I think those are all good holdings. I think those are all great holdings. But personally, I think you could probably ditch some of those ETFs. I don't think you need VU, VTI, VYM, and SCHD. Like if I was you, I would just pick probably 2 out of those, or even you could even get away with just owning 1. If you were gonna own 2 of them, I would say maybe SCHD and VU would be good to have along with those other stocks that you mentioned. And there's still even going to be some crossover in there, but that's okay. If you just wanted to hold 1 ETF, you could get away with just owning any one of those ETFs. You could just have SCHD, you could just have VTI, you could just have VU, you could just have VYM. I personally don't think you need all 4. I think it's a bit overkill with the ETFs. That's just my take though. Let me know what you guys think about that too in the live chat in the comments below. There's probably going to be different schools of thought on this, which is totally fine. At some point it's preferential, which is totally fine because that's why they call it personal finance. You got to do what you personally think is best. But that's my take. Let's see. Jan here. Hi there. IIPR with a near 67% 5-year dividend growth CAGR. That's crazy. That's super high. Let's see here. Oh, Alfredo, what do you think about Zim? I am not a fan of Zim. I'm not a fan of Zim. I put out a video a few months ago called, it was titled, Avoid These Dividend Stocks at All Costs. And one of the stocks in that video was Zim. But just really quickly, we'll take a look at them on Seeking Alpha, and I'll give you a couple reasons why I'm not the biggest fan of this company, really. Let's actually just start with their dividend here, okay? I mean, in the trailing 12 months in the last year, they've got a 140% dividend yield, which it's like, I mean, right off the bat, that should just raise some red flags. At least that should get your spidey senses tingling a little bit. 140%, really? And if we go over to the dividend history right here, and a lot of people are going to be drawn in by that super high yield, right? But if we go over here to the max chart, the dividend's pretty, it looks like now it's quarterly. Prior to that, it was just other. But really, this high yield is coming from this one payment right here, which I believe was, I thought that was a special dividend payment. But anyway, this super high $17 dividend, I remember them paying this. It was huge news in the dividend investing community. But that's what brought the dividend yield on this company way up. But since then, this yield has dropped way back down. Still not bad. 475, 295, that's still like an over 10% yield. So the yield's still going to be really high. I'm just not a fan of it. And if we go over to the financials to me don't indicate really any consistent growth. Let me try and zoom in here a little bit. If we look at this revenue chart, you can see that for the most part, it's pretty flat. There's really not much growth on the top line, which if there's no growth in the top line, it's going to be hard to continue growing that dividend, which that along with the super high dividend yield, those two in conjunction definitely raise some red flags to me. But we can see here, if we're looking at this chart a little bit closer, on the far right, there's a huge jump in revenue, which if we scroll all the way over to 2021, they just had a really good year in 2020-21. Tons of supply chain issues. Shipping was all over the place. So if I remember correctly, they were just really able to raise their rates, which obviously generated more sales for them, resulted in more top line and bottom line growth just for that year. But we'll see what happens, since then. But I would imagine that if not like ASAP, sometime soon after, the revenue will start to look more again like this. I think it will revert back to the mean, in which case the dividend, in my opinion, will not be something that is sustainable. And personally, that's just something I would want to stay away from. So that's kind of why I'm not the biggest fan of Zim. Hopefully that makes sense. Okay, let's keep going. Looks like I'm a few minutes behind in the live chat, which is really not bad for me. Usually at this point, guys, I'd be like 25 minutes behind. I'm usually pretty slow. Mike wants to know, do you own Vici since you live in Vegas? No, man, but I really should. And I really do like Vici as a company. I've been kind of adding other things. I've been working on other things. I don't know what's up with me and the British accent tonight. I've been watching a lot of Love Island, so that's probably where it's coming from. But no, I don't own any Vici properties. It's something that I would like to have in my portfolio, and it's something that I always keep in the back of my mind. And at some point, I could see myself adding it. But yeah, I think it's a really great real estate investment trust. A really fun one to own too. Just to be an owner of a piece of the Las Vegas Strip, I think is a really, really cool thing. Let's see. Oh, this is a very interesting question and not one that I've really thought about. Ryan, what do you think of the quad-effect approach for early retirement? I'm actually going to save this comment because this might be a good thing to make a video around. So, Ghost of Toby, thank you so much for the question. But anyway, what do you think about the quadfecta approach for early retirement? It's basically putting your money into 4 covered call ETFs. I don't know. Excuse me. I think it's too soon to tell. I think it's too soon to tell what the long-term results are going to look like with these covered call ETFs because, excuse me, guys, man, because many of them have not been around for a long period of time. I think isn't JEPI the oldest one, and they came onto the market back in 2020. I don't know, maybe QILD and XYLD and RYLD came on before then. I don't remember, but if they did, it was not too long before JEPI. But also, so that's point number one. Like, I don't know yet because we just don't know how these covered call ETFs are going to perform across a long period of time. I have JEPI in my portfolio, and I've been pretty happy with it. But it's not something that I feel like I'd want to put I wouldn't want to put all my eggs in that basket. And furthermore, I personally wouldn't want to put all my eggs into just covered call ETFs. I would want to be more diversified than that. And also, I don't really know, like, what would be the point of having 4 different covered call ETFs? Like, ones like JEPI and XYLD and QILD, don't they more or less kind of do the same thing? they all write covered calls, I think, just on different indices. I mean, JEPI and XYLD, I think both do it on the S&P 500. JEPI through the ELNs. I think QILD does it on the NASDAQ maybe, or the Dow Jones. Maybe it was a different index, but I don't know. I think it probably would be a good way to generate overall Toby, the ghost of Toby, Toby's ghost. I think it would probably be a great way to generate some monthly income. But like starting now, like if you're starting investing now or whatever, and have a period of years before you can retire, I don't know. I just don't know that I would go that route, but I don't know. I really just don't know, I guess is the bottom line. I don't know. I was about to say it again. I don't need to. But actually, having said that, let's expand on this a little bit. I don't think it would be a bad idea. I've seen some other people do this. I don't think it would be a bad idea to have a portfolio that's something like JEPI plus SCHD, or like JEPI plus VU. I think that's a pretty decent balance. But I wouldn't go into 4 different cover call ETFs and just that be it. That's just my take though. So, and then Kevin has an interesting point here. Having a higher dividend percent to begin with inhibits growth. So Kevin's basically saying having a higher dividend yield, in most cases, you're not gonna benefit from share price appreciation as much. And this is something I've talked about a decent amount of times, and I'm happy to keep talking about it because I think it's an important point. One thing to keep in mind too when it comes to share price appreciation versus dividend income. So basically, compare something like maybe something like Google, which is a growth stock, right, to something like like a high yielding. Let's say it's to JEPI. Okay, let's just use JEPI. So Google to JEPI. Obviously, Google's returns are going to come from share price appreciation. JEPI's returns are going to come from dividend income or distributions, whatever you want to call them. But really, guys, at the end of the day, your share price returns plus your cash flow returns, your dividend income, the dividend yield percent that you receive, that adds up to be your total return. And at the end of the day, that's really what matters. And so what you as the investor need to determine is, where do you want, when it comes to your total returns, like how do you want those allocated? Do you want that to be coming more from share price appreciation, or would you rather have that come from dividend income? And, there's pros and cons to both, right? The pro to coming to share price appreciation is that you're going to be able to delay the tax implications. Whereas with dividend income, you're getting taxed every time you get those dividends, which, personally, I think is a small price to pay. That's why I don't mind being a dividend investor. And I think that's a pretty low hanging fruit for people who like to talk bad about dividend income, is they say, oh, well, it's taxed twice, or it's, the tax aspect of dividend income is not ideal, which that's fine. Like, no strategy is perfect. But anyway, the point being, I don't think it's always a bad thing to not have share price appreciation if you are making up for those returns with dividend income. Like at the end of the day, so JEPI, for example, what's their dividend yield? 11%. An 11% cash flow return is really going to, in dollars, it's going to be the same return as an 11% share price appreciation growth. Like if Google jumped 11%, if you had an equal amount invested in Google and JEPI, Google jumped 11%, JEPI gave you 11% dividend yield in 1 year, the dollar amount's going to be the same. And that's your total return. This is a good question too. So Tara wants to know, dividend investing, is it better in a regular taxable account or is it better in the Roth? This is a great question. So it just depends on a few different things. So Roth IRAs are going to be more tax advantageous. So when you invest in a Roth IRA, the share price returns, the dividend income you receive, you're not, it's tax free. You get to benefit from that without having to worry about paying taxes. But the caveat to a Roth IRA is that every single year, starting this year, you can only invest up to $6,500 into that portfolio every single year, which for most average people, I'd say is like, that's fine. Most people aren't going to invest above that. I shouldn't say most people, but a fair amount of people are not going to invest above that limit, so that's fine. The second caveat is you're not able to withdraw those funds. You can withdraw your contribution, so the money you invest, you can withdraw that at any time without penalty. But the gains, the share price returns, the dividend income you receive, if you pull that out before the age of 59 and a half, there will be some penalties you'll have to pay, which kind of sucks, And this is where it comes down to like knowing. This is where it's helpful to know, like, when do you plan to retire? Do you plan to retire like an average standard age, maybe like 65, 60 to 65? If that's the case, if that's your plan, then a Roth IRA is certainly a good thing to prioritize. However, if you're someone who's gung-ho about retiring considerably earlier, like maybe you're really shooting for like early 50s, or maybe you're shooting for even earlier, maybe in the 40s, which is feasible which is totally feasible. People do that. And if that's you, then it might be, tax consequences aside, it might be better off. You might be better off just, or even I should say, taking the taxes into consideration. You may be better off just doing more in your taxable. Me personally, like I ideally really plan to live off of my dividend income as early as I can, like ideally long before 59 and a half. So I invest more into my taxable brokerage account, but at the same time, I still have a Roth IRA, because at some point I will be 59 and a half. And when I reach that point, it will be nice to have some additional income coming in that I don't have to pay taxes on, And so that's my take. I think it's good to have both, and which one you prioritize, I think should depend on your timeline. But at the same time, most people are going to say, nope, Ryan, like that's off base. You got to take advantage of the tax-free situation. You got to max out your Roth before you invest in the taxable, which is fine. Just there's so many things that are like subjective when it comes to investing. Once again, that's why they call it personal finance. So sorry guys. Now I'm like 10 minutes behind in the live chat. Catch up here. Okay, let's see. Okay, I think this is a question. Let me read through this real quick. Oh, this was about the covered call ETFs earlier. I think retire early is better when you plan. When is retirement for you? If it's early, by growth. Oh, maybe not. Okay, this is interesting. Thoughts on Scott's Miracle Grow and the rise of it the last month and a half. So, I don't remember exactly why they jumped up so much. I'm going to pull them up here on Seeking Alpha. But I remember saying they had a crazy jump. I remember what it was. It was after earnings. So they reported some better than expected earnings, which is why they jumped so much. And just looking here, guys, in the last month, they've jumped almost 42%. Prior to that, they were down in like the low 50s or maybe even in the 40s, right? So 50s. Last 6 months, so they were down as low as about $45 a share. But what happened in the last, however long, month or so, beginning of February, they reported earnings that beat estimates. So the earnings per share beat by 32 cents, revenue beat by 24 million. But the thing is, like, even their earnings beat, like their earnings were still negative for the quarter, and their revenue was still down year over year. But because it beat the analyst estimates, the stock just soared. It really climbed. And truth be told, I want to like Scott's Miracle Grow a lot more than I do, because I think in that industry, in the lawn and garden industry, it has a really strong brand. And it doesn't. I mean, Scott's Miracle Grow, Bonnie plants. Those are really. I actually saw a Bonnie. I was looking out my window the other day, just randomly saw a Bonnie plants truck drive by. And yeah, I don't know. I think, like I said, I really wanted to like this company more than I did. I don't think the financials look too great. I think the debt situation, from what I remember, is getting worse over time. The dividend stats aren't anything crazy. So I don't know, but I think the brand is strong. That's one thing they have going for them. And if they can come up with some better financials, I think, or kind of get that more in tune with what I'd like to see. And I actually don't really remember what was going on with their financials. Let's take a quick look at this. I think their revenue might be growing. So yeah, so kind of, sort of. Like the revenue for the most part's growing, but it dipped between 2021 and 2022. And if we go look at the balance sheet real quick, just looking at the debt situation real quick, like look at that. The net debt is really increasing big time across the last 10 years. So it's currently about $3.6 billion. And looking at their free cash flow, so $3.6 billion of net debt, cash flow, they're only bringing in about $300 million of free cash flow in the trailing 12 months. Part of that was negative, and otherwise it's not looking too great. At least not great enough to, I think, go with how much debt they have. And let's see what's their long-term debt looking like? How much of this is long-term? So it's long-term assets, current liabilities, so long-term debt. So most of their debt is long-term, which is good to see. But still, I can't say I'm the biggest fan of Scott's Miracle-Gro, unfortunately. Let's see here. Yeah, Dan, this is a good point. Let the dividend haters keep on hating while we sit back and collect checks. I agree, my friend. I agree. And this is a good question, too. Will you ever dip into options trading, my brother? Never say never. It's something I think about, and kind of my answer to that is, at some point I'm sure I will. But if I'm going to do that, like I just want more money. I want to have more. How do I say this? If I have more money to play with, I wouldn't mind, starting with options. I wouldn't mind doing some covered calls, maybe doing some cash secured puts, but I'm just not there yet. And so the money that I currently do have, I just would like to just keep investing and building some bigger positions in and going long, as they say. But yeah, and who knows too, like there's a couple stocks in my portfolio I do have over 100 shares with. AT&T, ORCC. I'm kind of getting close with EPD. I don't think any of those are really going to be good ones to do options with, but at some point I wouldn't mind doing options. I know there's so many people who make some serious money with options. Like I think Kevin Burgess, if you're still in here, Kevin does really well with options from what I've seen. My friend Wayne Nichols, who actually also lives in Las Vegas. He's got a great YouTube channel he started a few months ago, guys. I think you should check it out. Wayne Nichols. He's killing it with options. He's like, there's some months he's making like multiple thousands of dollars from trading options. He's crushing it. So yeah, I see that and I get excited about it and I say, someday. But for now, I'm good not doing it. I'm good staying on the sidelines. TCAF, hey Ryan, what are your thoughts on Seeking Alpha? Oh, more specifically, their rating system. It's not something I really pay too much attention to. Like, if we go back here, it'll show the Seeking Alpha authors say it's a buy. The Wall Street says it's a buy. Their quant ratings says it's a sell. And if we go over to the dividend stats, like the premium version shows you the grades. I don't really pay too much attention to these. Like sometimes I'll reference them, but it's not something I'd put too much stock into. But I really do love Seeking Alpha. It's my go-to stock, It's my go-to stock research platform. And I really enjoy reading all the articles. I spend a lot of time doing that. And I think it's a great platform. But as far as like the quant ratings, the Wall Street ratings, the Seeking Alpha authors, I always just take it with a grain of salt. And it's just like taking, buy, sell, or hold advice from people on YouTube. Just don't do it. You gotta, don't do it. Don't do it. You got to do your own due diligence, as they say, and that's such a cliche when it comes to making these videos or whatever, but it's so true. I think watching YouTube videos or reading Seeking Alpha articles or seeing the quant ratings or whatnot, I think it's a good reference point, and I think for someone who's like looking for ideas, it's a good place to go. Like it's good to watch videos on 5 stocks with huge dividend raises just to get an idea of what companies are out there and what they're doing. But by no means is it like, should you base your investment thesis on like what people on here have to say or what people on Seeking Alpha have to write. It's helpful, but you gotta draw your own conclusions, Okay, Keith, started getting into investments, and you were the first person I started watching. My friend, I am so honored. Thank you so much. How much do you plan on contributing this year? Also, what's your day job slash dream job? So that first question, how much do I plan on contributing? At this point, I'm investing basically $200 a week. 150 of that goes into my main portfolio, my primary portfolio on Charles Schwab. The other 50 goes into M1 Finance. And, I'd like to increase that. I'd like to increase that at some point. And my goal is to, at some point, increase that. And when I do, I'll keep the same amount of contributions in my main portfolio, but I'll bump up the Roth contributions to like $100 a week. And so I want to get to a point where I'm maxing out the Roth, finally maxing out the Roth before I'm increasing in my taxable. So hopefully that answers your question, Keith. And the second job, what is your day job slash dream job? I mean, fortunately, I'm doing it. Like, I'm making these videos since October, which is crazy. I only thought I was going to be able to do it for like a couple months, and I'm still trying to see like how sustainable this is going to be. It's still kind of testing the waters, but I'm 5 months into doing YouTube stuff full time and writing my newsletter, and just talking about dividend stocks, and that's my day job right now, and it's also my dream job. I'm so fortunate, like I said, to be able to do this. I have to pinch myself sometimes. I can't believe it. So, and thank you guys for all the support, because it wouldn't be possible without you. But yeah, I'm going to keep rocking with this as long as I can and keep growing it. Yeah, Adon says, so about like a Roth versus a taxable account. And I've gotten some pushback, because this is something I've said in the past too. And I've gotten some pushback on that. Like I said, people say, you got to take advantage of the tax-free Roth IRA. Like, you got to max out the Roth before you do the taxable. But I really do just think it depends. Like, if you have a real shot and you can crunch the numbers, like there's so many dividend calculators out there, marketbeat.com, the dividend tracker, those are two of my favorite ways to calculate like the future value of a portfolio. On my free dividend portfolio tracking spreadsheet, there is a future value calculator, but I think these other ones I mentioned are better. So you can do the math. And if you have a real shot, a real genuine shot at retiring early, and by early, I mean like before the standard age, like technically, I guess I mean before like you can start withdrawing from your Roth. Anything before that, I think, is early, quote unquote early. If you have a real shot at doing that, I think it makes more sense to go the taxable route. But, I also, is kind of I don't want to say a backup plan, but, kind of an extra sort of thing. I call it margarita money. That's the name of my Roth IRA. It's just kind of some more fun money, if you will. It doesn't hurt to have that Roth IRA, because someday you will reach that 59.5, and someday you will be able to benefit from that tax-free. So, that's not nothing. That could be huge. So, okay, guys, maybe a couple more questions. It's almost 6:00, and it's Friday night, which you guys know what that means. It's Chipotle night. After I get off this stream, headed straight to Chipotle, gonna pick up a big old burrito. So, a couple more questions, guys, and we'll get out of here. I'll get out of your hair, okay? Let's see here. Caleb, man, thank you so much. Your Dividend live chat Fridays are the best. Thanks, Ryan. I really appreciate that. And at some point, I'd like to do an additional live stream I'm thinking like maybe like Sunday mornings. I'd really love to do an additional live stream. I'm thinking about, just for full transparency, guys, in the next few months, I'm thinking about starting a Patreon. I'm still, I know, and it's like, of course, like every YouTube creator has a Patreon, but it's something I'm thinking about doing. And kind of my thought with that is because I'd love to do more of these live streams, and because I have so much fun doing it, even just sitting here hanging out with you guys, answering the questions and whatnot. This is my favorite part of it. And so what I'd like to do in the next couple of months is I'd like to start a Patreon where we do these, like on these dividend happy hours, we do like just the first hour here on YouTube, and then maybe do like an additional hour number 2, like on the Patreon or something like that. And then I'd also like to do because you guys know I release my normal videos every Sunday morning, Sundays and Wednesdays at 8 a.m. So another thing I'd like to do through Patreon when I start that up is do an additional live stream on Sunday mornings. So if I have my video going live at 8 on Sunday morning, maybe do like another live stream like at 9 a.m. on Sunday mornings. And because I know there's a lot of people here who don't often get to join these Friday night live streams, because there's, fortunately, like, we're getting a lot of international viewers, people in Europe. We've got some people down under. So we've got people all over the world now watching these videos, which is crazy. And I know a lot of them can't join these live streams. So it'd be nice to do an additional thing on a Sunday morning or something. And instead of coming and making it the Dividend Happy Hour, maybe we're doing coffee and cash flow. Kind of a same feel, just different time, same sort of thing. But that's kind of my goal. So, and that's something I'm going to be working on these next few months. There's just been a lot going on though, guys. Like, I recently put out this new version 6 of the spreadsheet. That's been a lot of work. I've been working on this stock analyzer tool, which I have it pulled up here. I'll show it to you guys. And you've seen it in some of my videos before. I showed it in my last video. I'll be talking about it more. I'll be showing it more in this Sunday's video. But this bad boy right here, I'm going to be putting this out probably in the next month or so is my goal. And so, there's just a lot going on. I've been working on some other things. But once I get this new spreadsheet out to you guys, I'm going to start working on putting a Patreon together and doing that. I think it'll be a lot of fun. And I just think it'll be a lot of fun. I really do. I'm really excited about it. I'm really excited to do more of these live streams. So let's see here. Kevin, didn't realize you went full-time with Dividend Stock Media. You're doing a great job, and we all enjoy following you. Man, Kevin, thank you so much. Like I said, man, I just pinch myself sometimes. It's crazy. And, we're going to see how long I can keep it going. But going back to, the Patreon thing, and, I think that'll help make this more sustainable. And, I don't want to make it like a money grab sort of thing. But the reality is, if I do want to do this as a living and do it sustainably for a long period of time, and also do it and continue to grow my portfolio and at hopefully a faster rate, I think this is a necessary move. And, hopefully there will be some value in it too, which, there's a lot of people that keep coming back for these streams. So, I think there is. And so, yeah, I mean, long story short, Kevin, thank you so much for the support. I really appreciate all you guys once again. Okay, one more question, guys. Okay. Actually, a couple more questions. Sorry. Let me get caught up. I'm almost caught up in the live chat. What about a live stream with you and Russ and Darth and Ari again? Yes. So we have a group chat. The 4 of us have a group chat. We always talk, and we need to get something on the books for this month. I'll text them about that tomorrow or something like that, and see if maybe we can do something in the next couple weeks. And if we do, we'll do it on my channel here. So we'll do it we'll probably make it make it just like a Dividend Happy Hour, ideally. I'd love to do more stuff with those guys. It's always fun being able to chat with them. Let's see here. Okay, well, yeah, I'm all caught up here in the in the live chat. So I will get out of your guys' hair. It is burrito time, and thank you guys once again so much for all the support on the channel and for always tuning into these Dividend Happy Hours. I always have fun hanging out with you guys. And with that, I hope you guys have a fantastic weekend. Hope you guys keep up. No, I don't hope you guys. I know you will. Keep up the great work. I really appreciate all you guys. I hope you have a fantastic weekend. And I will see you on Sunday's video, guys. Definitely tune in. It's going to be a good one. It's actually going to be a longer one. It's almost like 13 minutes long. So that's a bit above average length for me. So definitely check that out. And I'll catch you guys later.